What is going on, guys, and welcome back to the channel. Now, let's be honest, the last year has been an absolute bloodbath on the stock market, with pretty much every sector ending the year down, and even those not as badly hit have struggled to make much in terms of gains. Tech especially has been hit incredibly hard, with the Nasdaq down around 25 to 30% in a year. Pretty much the only exception is the energy sector, which has really thrived this year. Now, in light of the fact that we've had a terrible year on the stock market in 2022, what I'm going to do is show you guys exactly how badly my own portfolio has done this past year, and actually since I started investing. This will be looking at all of my long-term investment portfolios. However, what this won't include are my other portfolios focused on trading or crypto. Once we've gone through everything, I'll give you guys a bit of an insight into what my plan is moving forward and what I've learned from some of the mistakes I've made, and whether or not this performance has affected my overall strategy. But before we get into it, if you're not already, make sure to hit that subscribe button down below and click that bell so you never miss a video, because this channel is dedicated to helping you guys by making finance more accessible. Now, if you are looking to start investing for yourself, check out Trading 212. If you sign up using my referral link down below in the description, you'll get one free share when you open an account. And in my opinion, they're one of the best investment platforms out there at the moment. And the best thing about them is that they offer commission-free trading, and they're fully authorized and regulated by the Financial Conduct Authority. Now, just as a quick disclaimer, this is in no way financial or investment advice. I'm simply just sharing my experiences and opinions. Always make sure to do your own research and due diligence when it comes to your finances. And remember that investments can rise and fall and your capital is at risk. But with all of that out of the way, let's get into it. Okay, just before we get looking at the portfolio itself, I just want to give you guys a bit more background into what the purpose of this portfolio is and what my investing intentions are. So like I said before, this is my long-term investment portfolio, and it's held within a number of different accounts with ISAs and general investment accounts, and all of the accounts are combined together to create one overall portfolio. The fundamental strategy is long-term growth, aiming to build wealth over time and outperform indexes. There tends to be minimal trading within this portfolio, except for buying more when I add money consistently each month, rebalancing occasionally, and also selling off stocks and funds that I don't see value in anymore. I try not to react to overall market corrections and crashes. Instead, I just try and buy more and take advantage of those lower prices. Now, the way this data has been collected is using my own investment tracking template, which is a free download on Google Sheets if you're interested. And I'll link the video of exactly how that works and how to use it down below. But for the purposes of this video, all you need to know is that it tracks my portfolio at the end of every single calendar month. And all I need to fill in is my portfolio balances, the amount of money that has been added or subtracted from the accounts. It then generates a performance comparison from my own portfolio and the indexes that I've chosen. For these indexes, it's not just showing the share price, it's actually creating a scenario as if I'd invested the exact amount of money that I have in my portfolio into these indexes, taking into account all of the additions and withdrawals. So I can get a really clear idea of exactly how well I'm doing against these indexes. Within these comparisons, there are two things that they don't take into account. First being fees. So in these generated scenarios, it's assuming that you're investing directly into the index, not an index fund that charges fees. So the performance would be slightly worse if you were to invest in index funds tracking these indexes, as they all charge some fees, and sometimes you'll have platform fees as well, which can't be avoided. The generated scenarios also assume that every last penny in the account is invested, which in reality is not the case with my portfolio. I try to always keep a reserve of cash and not be 100% invested, just in case an opportunity presents itself. We're also going to be looking at percentages only rather than monetary value of the portfolio. Percentage change is what's important for investors and what's actually scalable. That basically covers all of the background of what you need to know. So let's dive in and look at the portfolio. Okay, so here it is. This is my long-term investment portfolio from pretty much when I started investing back in 2013. How this chart is set up is basically 100% is 0% change, and anything over or under 100% is whatever that percentage is in growth or loss. So we can see here the Nasdaq is 150%, that actually means 54% up. Whereas with the FTSE 100, here we have 88%, that actually means 12% down. And what this chart is tracking is my overall investment portfolio against the FTSE 100, FTSE 350, the FTSE small cap, the S&P 500 and the Nasdaq 100. And all of this is getting information from Google Finance, so it's 100% accurate. So when I first started investing, I didn't have a particularly good way of tracking my investments, and I didn't do it that regularly. So that's why the line doesn't really follow any sort of trend to start with. But then you can see from about 2016, I started to be more consistent tracking it. And from 2016 to 2018, I had a pretty consistent growth on my portfolio. and I actually outperformed the S&P 500, which is a pretty good benchmark. So we can see my all-time high on the portfolio was 76% up in May 2018. So from May 2018 all the way down to March 2020, we can see I've pretty consistently followed the S&P 500 into the COVID crash. And that's really where it all starts to look like it's going wrong. So from March 2020, I've had similar performance to the S&P 500, but actually getting overtaken by the FTSE small cap. And then from about August 2021, my portfolio has had a massive decline compared to all of the indexes and sort of followed the same trajectory as the Nasdaq by the looks of it. And at this point in time, I'm now actually 6% down from when I first started investing, which isn't great, let's be honest. And from looking at just this chart, it's actually quite discouraging because if I'd invested in the Nasdaq 100 exclusively, I'd have had much better performance overall. And also I'd still be 23% up in theory, which is also the same as if I'd invested in the S&P 500 at this point. Now, like I said before, this doesn't take into account fees and charges, as well as money sat in cash within my account. So what this means is, in order for my portfolio to actually follow the same trajectory as some of these indexes, I'd actually have to slightly outperform them to take into account the costs and charges and the fact that I'm not 100% invested with all my money in the account. So now we've looked at the overall performance of the portfolio since its start. Let's now look at the last 3 years to see if that will give us a bit more detail as to what's gone wrong. So now we have a chart showing a 3-year period starting from the beginning of 2020, just before the COVID crash. So first we see where the COVID crash happened, and you see things like the Nasdaq recovering massively well, as well as the S&P 500 and the FTSE small cap. My portfolio didn't recover as well, but has had a consistent uptrend until around July 2021. And actually at that point, it basically caught up with the Nasdaq and the S&P 500 over that 3-year stint. Now, the reason my portfolio didn't recover particularly well after COVID was actually that I was pretty heavily invested just before the crash happened, and I didn't have a lot of buying power during the crash. This was a good learning point for me to try not to be too fully invested at any one time, because if there is a pullback, there isn't a lot you can do if you want to take advantage of the market dip. Another reason my portfolio didn't recover as quickly was because I was actually taking profits during the recovery period, and a lot of investments were shooting up so rapidly that it all seemed a bit too good to be true. So there were points where I was taking profits and keeping more money in cash. I don't really regret this, and I think it's a sensible thing to do, especially considering this is where I keep the majority of my money. So it is sensible to take these precautions. So now in July 2021, where it all starts to go wrong again, let's now look at this over a 2-year chart. So from looking at the start of 2021 to the present day, you can see that throughout 2021, my portfolio has been pretty stagnant. It started off the year down, but was recovering. But then you can see around June is where it all started to tail off. And there's 2 main reasons for this. The first being that I was quite heavily exposed to the Chinese markets, and probably more so than I should have been. And it was at around that time that all of the Chinese stocks were starting to take a massive hit. So my portfolio did get hit slightly, and I ended up selling out of all of my Chinese investments. And to demonstrate this, you can see on the JP Morgan China Growth and Income Investment Trust chart, you can see that exactly in June, July 2021 is where everything started to decline quite severely. So all things considered, I'm glad I got out when I did. And up until that point, it had been a good investment that had made me a fair amount of money. So can't really complain. Now, the other reason for my portfolio doing so poorly at that exact same time is because I started the process of purchasing my first property. As a precaution, I sold a fair amount of other investments to just keep some money sat in cash to basically pay for the house. Now, in theory, yes, I could have left some of that money invested, but in all honesty, I just didn't think it was worth taking the risk, because 6 months from then, I needed to come up with a lot of money. If I was still heavily invested and there was a market crash in that time period, that really wouldn't have been good, and it could have affected the purchase of the property. Hindsight is a great thing, and looking back, if I left the money fully invested, I would have actually come out on top, but you never know what's going to happen. And the reality is, with investing, you're always going to have to leave money on the table at some point, and it's impossible to maximize profits fully. When the purchase of the property finally went through, that was in December of 2021. And then it was around then, at the start of 2022, where the stock market started crashing across the board. So let's now just look at one more chart over a 1-year period, just looking at 2022. So this final chart looks at just that 1-year period, so it won't take into account all of the previous things that have happened in the years before. So for example, the lack of growth due to the house purchase and keeping money sat in cash. So basically, over this period, my portfolio has taken the biggest beating compared to all of these indexes. But encouragingly, it's doing ever so slightly better than the Nasdaq 100. But that being said, I'm still about 30% down on the year, which isn't great. Now, when I look at this performance, it honestly doesn't worry me in the slightest. The things that I invest in are relatively high risk. And when you're investing in higher risk things, generally you have bigger returns, but also bigger losses when the market's doing badly. And honestly, when I look at this, it just makes total sense because my portfolio is high risk and high reward. And with a strategy like this, you just have to be prepared and be comfortable with having these on-screen losses, even if you haven't actually sold the investments. So overall, I'm actually pretty happy with how my portfolio has performed. Moving into this year, my strategy honestly isn't going to change whatsoever. I'm going to continue investing into higher risk opportunities with the potential of higher returns. And I'm honestly really excited to see where this year goes because I think it is a great time to invest. There's a lot of opportunity out there and some chances to get into some really good investments at a really discounted price. And we're seeing a lot of investments sitting back at pre-COVID levels and some lower than where they were at during the COVID crash, which to me suggests that some of it is an overreaction. So my strategy for this year is to simply just try and put as much money back into the stock market as possible and to try and get my portfolio to recover back above these indexes. Obviously, when it comes to investing, no one knows exactly what the future holds, but this is just my outlook at the moment, and I'm feeling quite positive about it moving forward. Now, I just quickly want to run through the main lessons that I've learned from this process of tracking my investments and seeing how well I've done against the indexes. First being, it is not possible to be a perfect investor. You have to accept that you're always going to leave money on the table. And it's important to not get discouraged by this because it's not possible to buy at the bottom and sell at the top every time. Sometimes you might get lucky, but it really isn't possible to get everything timed perfectly. Following on from this point, it's also vital to not get driven by greed. Where I've gone wrong with this is being too eager to get fully invested, when actually keeping money in cash isn't always a bad thing. And in all honesty, it's quite often a sensible thing to do. And the final point is that you need to be mentally prepared for the type of investing that you're doing. So for example, I invest with a high risk, high return strategy. But with that strategy, I have to be comfortable with seeing really significant paper losses that are more severe than those who have a less risky strategy. And I think it's just really important to find a strategy that you feel comfortable with. If you're not comfortable with high levels of volatility, maybe you should look at something a little bit less risky. But there we have it. That basically covers everything for today, guys. Please let me know your thoughts on my investment performance down below in the comments. And let me know how you guys did over the last couple of years. As I said before, I will leave a link to my investment tracking template down below in the description if you guys are interested. I think the information that it gives you after a couple of years is so useful, and the only effort it requires is filling it in once a month. Now, if you are looking to start investing for yourself, check out Trading 212. If you sign up using my referral link down below in the description, you'll get one free share when you open an account. Now, this channel is focused on helping you guys by making finance more accessible and manageable. So if you're not already, make sure to hit that subscribe button down below and click that bell so you never miss a video. But with all of that being said, take it easy guys and have a great rest of your day.